Hello, and thank you for your time. My name is Eric Jefferson, Managing Partner of Trestlebridge Capital, Chief Investment Officer at Flagship Harbor Advisors. It's such a big week last week. Wanted to spend a few minutes digesting the news that drove the S&P over 4% higher, bringing the total return the month of July to north of 9%, actually the best monthly return going back to November of 2020. And from my seat, there were three major headlines that drove markets. First, we had about two-thirds of the way through earnings season, heard from the Federal Reserve, then got the Q2 US GDP reading. So I'll take those in order. Starting with earnings, we have a time-honored tradition where once a quarter we hear from corporate executives. They're going to discuss how their companies did and their outlook ahead. And why this is so important is earnings historically are the number one driver of stock prices. So far, we've heard from about two-thirds of the companies in the S&P 500, and the best way to describe this earnings season would be resiliency. We've heard companies have found a way to adapt and thrive in what has obviously been a very challenging environment. One of the primary ways they've done that is by passing along higher costs to end consumers. Additionally, we've seen consumers demonstrate resiliency by continuing to go out and spend despite higher prices. And that speaks to the overall strength of the US consumer, theme that we're talking about for some time. Secondly, on Wednesday, we heard from the Federal Reserve President Jerome Powell that he announced a 75 basis point rate hike. That was widely expected. That is the Fed's primary mechanism to combat inflation or higher prices. However, he did offer some very interesting comments where he suggested that the pace of future rate hikes may be slowing sooner than expected. Now, not surprisingly, the market reacted very favorably to this news. However, it struck me as very curious that without any meaningful progress on inflation, they offered these reassurances. Time and time again, the Fed has come out, continually reiterated tackling inflation as their number one priority. They've confirmed they're willing to back off raising rates once they see some sustained improvement. And then all of a sudden, without any improvement whatsoever, they began playing good cop. It almost seemed like they were telling the market what it wanted to hear. Additionally, Powell then acknowledged that although growth is slowing, he didn't yet believe we were in a recession, citing a strong labor market. Then the very next day, that Thursday, we got the Q2 GDP reading, showing that real GDP fell by 0.9% or 90 basis points. That now marks the second consecutive quarter of GDP decline, which under the old method counts as a technical recession. Granted, there have been some changes. We now have the National Bureau of Economic Research will make an official determination based on a number of factors. At the end of the day, this has obviously created a lot of confusion. If you turn on Fox News, we're in recession. If you turn on CNN, we're not. One thing we can agree on, growth is slowing. At this point, I wouldn't be surprised if even in Q3, we had a slightly negative print. A month ago, I suggested it was probably a 50-50 probability whether we go into recession or not. But the one point that I'd like to highlight is not all recessions are created equal. We're likely in one right now, but if you go into LinkedIn, there's likely 5 people you know that are starting new jobs. Again, it doesn't feel like a 2008 or even a 2001 type recession. Now, following the strong performance, we've received a ton of questions. Is this a bear market rally? Have we finally reached the bottom? At this point, the consensus is very mixed. We have many calling for more volatility, while others believe this is a very attractive entry point. In my opinion, markets will likely remain volatile and range-bound over the short term until we get some clarity on inflation and the Fed. It's just hard to see a sustained rally in the absence of that confirmation, when again, we know that interest rates and the Fed policy is ultimately what is going to drive markets here. However, with longer term investors, folks that have, say, a 10 plus year time horizon, provided you're able and willing to withstand some volatility, this could certainly be an attractive entry point as stocks are still 10% below where they began this year. That's all for this week. Thank you again for your time. And as always, happy to discuss our outlook and positioning in more detail. Additionally, please note that the opinions voiced in this video are for general information only, not intended to provide a specific advice or recommendation for any individual. All performance references historical and is no guarantee of future results. Also, all indices are unmanaged and may not be invested into directly. All investing includes risks, including fluctuating prices and loss of principal. Thank you again for your time and have a great week.